Did you know that majority of traders fail for not having the ability to define market structure in real time? In this video, I'm going to explain how to have non-subjective rules of defining market structure and how to use that market structure that you've defined to take trades based on your entry rules. Remember, most of the time when the traders come to the charts, they already know the Dow theory of the market structure, so they know exactly what they are looking for. And one of the things is they'll come to a chart, for example, and open a random chart, probably H1 chart, and probably see the price generally has been moving this way, probably this way, and they say, well, the price is in an uptrend. Well, but there are a number of things that by the time you are saying this market is in an uptrend, which of course you are right, that the market is in an uptrend. But by the time you are saying this market is in an uptrend, there are a lot of mistakes already you've actually made, or there are a lot of things that you've ignored for you to come to a conclusion that this market structure is in an uptrend. So in this video, I'm going to go into nitty-gritties of what actually you are required to put in place to ensure that when you are backtesting and when you are trading, you are doing the same thing. Because from my experience, based on my experience before I understood the market structure, I was backtesting one thing, but when I'm trading one thing. Or today I'm backtesting one thing and tomorrow I'm backtesting a different thing in the name of market structure. Generally, I was right in terms of looking at what market structure is, in terms of looking whether the price was uptrend. Because, for example, when I come to this chart, let's just go to H4 and say probably zoom up to this position here. Obviously, anyone will say the market structure on H4 is downtrend. Now, are you right? Probably. But can you objectively use this kind of analysis to actually take trade? No. Because in reality, if you're saying that this market structure is generally in a downtrend, then that means if the H4 reaches here, will you still be looking for shorts? Will you still be selling? Because generally the market will still, if you zoom the way I've zoomed in, you'll just see still the market is actually facing downwards. So in this video, I'm trying to eliminate those subjectivities. Remember, Forex market is so subjective, but those subjectivities what makes now people lose money, because you can even show same chart to 10 different people and all of them will have different views and perception of what actually is happening in the market at that particular time. But is it a wrong thing to have those subjectivities between different people? No. But when those subjectivities now apply to one individual, now there is a problem. When those subjectivities are all about you, now that's why the problem starts. So now, for you to understand market structure, first you need to define the time frame. You can't just go to the charts and probably go to H1. You can just click, for example, here on H4, you have clearly said if we zoom this direction, you'll say the market structure is downward. You go to H1, you can clearly see the market structure now is going upward after a long move downward. You can go to M5 and you see market structure. Let's just market structure has been going up for the last like few minutes. You go to D1 and realize the market structure is D1 is down. You go to monthly, there is not even a shred of shift. The market structure is 100% down. So let's first define how we are going to approach this video so that you can understand. And just before I start, one of the reasons why it's important for you to have rules on how you analyze market structure is to eliminate subjectivity in relation to creating a trading plan. The trading plan that you're going to integrate inside your trading system. Remember, you're going to define your strategy, which will include the technicals. But within your trading system is not about strategy. Trading system now encompasses other things that you need to integrate. Now, inside the trading strategy, you're going to have rules of how you define certain things so that you can eliminate subjectivity. I'm sure if you are a student of of market trends, generally, you've already studied what we call the Dow theory, which is basically a market is trending upwards when it's making higher highs and higher lows. And the market is in a downtrend when it's making lower lows, and higher lows. So basically, based on the Dow theory, so let me just write here, this is basically the Dow theory of defining trends. So that means the market is making lower low, lower high, lower low, lower high, which means this low, this high is lower than this high, and this low, this high is lower, this low, sorry, meaning that this low here, this high is lower than this high, and this high is lower than this high. So generally, and this low is lower than this low, and this low is lower than this low. I mean, this low is lower than this low, this low is lower than this low. So generally, according to Dow theory, this market is trending downward. And the opposite is true. When the market is making higher lows and making higher highs, then the market is in a downtrend. Well, that is easy when I'm drawing them using such kind of lines. But in real market, the market is never that perfect. And that's why now you need rules. So this is how we are going to approach the video. One, you need to select the time frame. That is number one. So those are the rules. So you're going to write here all of those steps to come up with the rules. Come up with rules defining a swings. Those two are the most important. And remember, why are you defining the time frame? And remember, the time frame I'm talking about is a higher time frame. Remember, in Forex market, one of the most important thing is multi-time frame analysis. So when you're doing multi-time frame analysis, that means you start your analysis on higher time frame. For me, my analysis starts on H4. That is where I define the immediate trend. And I'm using that word immediate deliberately because I'm going to tell you why I'm using that word deliberately. When I say immediate, I mean exactly what is happening in the real time. Being a day trader, I may not be interested in what's going to happen in 2 weeks or even a week because I need a move that is going to happen in the next few hours or probably a maximum of 36 hours if sometimes I can hold a trade for over. The maximum sometimes I hold a trade probably is 48 hours, but that happens in rarity, just very rare. That's very rare. So number one thing is select the time frame. And the time frame, remember in this video, I'm specifically focusing on defining trend on your higher time frame. We're not talking about entry triggers. Those are other things I will talk about later, probably in the next video. You can actually tell me if you want me to go now into entry triggers. But now we're going to use the 4-hour time frame that I usually use. So this is what I usually do. And I'm going to go through different pairs so that we can actually see exactly what I mean by defining the immediate trend. So let's assume as I'm creating this video, the market is closed, it's on Saturday. But let's assume today is Monday. So I wake up in the morning, I find the market is here. Assuming that I want to trade CAD Swiss franc and I get this chart is here. I go straight to my H4 time frame because that is where I decide the trend. Now, first thing I do is to decide which market structure, what is the market structure on H4. So first I determine the most recent swing. Now in my case, I'll mark the most recent swing as this place. Now I'll explain why. The last time the market broke a structure, this market is generally in a downtrend. As you can see, I think that is not arguable as we speak. So generally the market has been moving downward by making, based on Dow theory, making lower lows. Making lower lows again, again. So that's what the market has been doing. So generally, market has been in a downtrend. But now, let's assume on Monday morning I come to the market and the market is this way. Nothing has happened. It's exactly the way it is. So I need to determine if the market is in a downtrend or in an uptrend. And how do I do that? I determine the immediate market structure. So remember, generally the market has been making lower lows, and there's no, if we look at this whole move, this move here, we cannot see any clear change of character. So generally the market is undoubted. But as a day trader, is that actually true? Now that's where your rules come in of how to define a swing. You need to know what is a pullback to you. How many candlesticks? You see, assuming that you just come to the market and you draw that if the market is making lower lows and then this is a downtrend, then how would you say this between this one and this one and this one and this one, which one actually is a swing? So you need to come up with rules. So for me, on my higher time frame, I need to see clear two candlesticks of the same color. Two clear, not dodges, not indecisions. I want to see two clear candles in the same direction. For me, that defines a swing. So basic rule is the market has to make 1, 2, 3 move. Now this one here, this becomes the swing low, and it only becomes a swing low if this high was broken. So if this high is broken, then now there's a continuation, assuming that the market was in a downtrend and that happens, then we'll say there is a change of character. So the market was moving downwards and then it has changed character. And just incorporate it, assuming that the market was moving in this direction. Then the market tries here and does such a thing. So the last swing was here. This is the one, this move, probably let me just add this one here. So this level here, let me just remove them first and redraw. So the market was making this move. It was this way, made this low, made this low, made this low, here, then again started making this move. Now, the market has been in a downtrend, was in a downtrend, as you can see. So I want to first decide the last swing that broke a low. So this is where the price came from when it was breaking this low here. This. So this is one of the most important swing. So when it's broken, then I can conclusively say the market structure has changed. But there is a catch. How many candles should be here, or what should be happening? Can it be one candle? Because remember, a pullback can be one candle in the market. For example, this one color candle here was a swing, it was a pullback. Well, can you use it? For me, I wouldn't. But remember, when the market is bearish and there is a green candle, if you go, for example, on a lower time frame, you will realize that this is H4. If you go probably on M15, realize that was a whole big pullback. So you need to decide rules on your higher time frame on how to define swings. So for me, I use two candles of the same color in a certain direction. So for me, this one here, this one is a pullback. This one is not. Why? Here I saw one, two, three, four, three successive candles. So my basic rules are I want to see at least 2 or 3 candles of the same color in the same direction. I'm not saying in decisions. Now when I'm saying 2 or 3, that looks a bit discretionary, but in reality you need to decide if it's 3 or 2. And the reason I'm saying 1 or 2, sometimes I have to look at the length and the size of the candles. Assuming that these candles here are huge green candles and then they are taken out, then I'm going to do that. But to avoid that subjectivity, you can even go down and say I'm going to stick to 3. So in this case, let's just stick to 3. 3 candlestick as the rule of a pullback. So now you come to this chart, you may say, well, the market is in an uptrend. But in reality, is it? Now let's just take an example of this. There may be another person who is using 2 rules and say the last time the market pulled back was this one here. So the person may say after the market came here, the market went upwards, pulled here, then broke the structure. Now there's one trader who will come and say, now on my higher time frame, the trend is upward. Now that kind of a trader is me. I am a day trader. This long-term move may not be important. Is it important? Yes, but I'm focused on the immediate trend. And there is a rule that for me is important, and that rule is 1, 2, 3 move. 1, 2, 3 move is the most important for me. I look for 1, 2, 3 move with this either 3. The rule is either 2 or 3 must break a structure to cause change of character. So for me, the basic rule of my reading market structure is I want to see 1, 2, 3 move with 2 or 3 causing break of structure. Now we are going to go a number of charts so that I can actually show you that. And there's another part that I always include, plus momentum. I want to see huge volume during the break. Volume. This is so important. In fact, let me just type it here separately. Volume, momentum. I want to see momentum during the break of a level. If the market was in a downtrend, I don't want this level to be broken by very mixed up candles. Now, let me show you. Why would I trade this market structure on H4 as a day trader as an uptrend? Why would I do that? The reason I will do that is because this area was broken by momentum. This huge candle for me gives me confidence. This one gives me confidence. The same color candles, huge. Remember these ones? Sorry, these candles, the H4 candles is 1, 2, 3, 4, 5, 6, 7, 8, 9. So those are almost 9 H4 candles, which means for this whole area it took almost 36, almost 24 hours. 48 hours for the price to move from this place to this place. But it has been taken out by only 8 hours. I want to see that. Immediately I see that those now previous 2 or 3 candles becomes my swing low. Same thing applied here. Now there's something that probably I'll now create another video on why reading market structure only is not enough in terms of trend. You need now to include other things like resistance and support, and I'll just go through it just as a by the way so that you understand. When I come to the market every morning, first I define the structure. So on this time frame, at this point I would have decided that my bias is uptrend. Why? Because my rules were met. And how were they met? I've seen 1, 2, sorry, this is 1, 1, and this is 3. 1, 2, 3 move with a break of structure. And which structure was broken? This. So, and is there volume or momentum? This candle, volume, this one here, broke this area with momentum. And this momentum, even before this pullback of 2 candles of same color, there's another momentum here. In fact, in a more advanced video, I can even tell you why probably change of character will have probably determined it to be starting from this position. But that's a story for another day. Let's just focus on this 1, 2, 3 move first. So when I come to the market, where other people will be thinking probably I'm supposed to be looking for shorts, for me I'll be looking as a day trader. Please, strictly as a day trader, I'm looking for long trades because rules have been met. 1, I've seen 1, 2, 3 move immediate, and that's now where I'm using the word immediate trend. Is the overall trend downtrend? Yes, this whole move is downtrend. But what is the immediate trend? As a day trader, this move may not help you because by the time probably you're capturing this move, the market will have changed direction, and probably the swingers, the swing traders, of course, are their bias probably is still in a downtrend. But you as a day trader, probably you are not. So for me, that one will be the reason why when I come to the market, I'll now be looking for long trades on CAD Swiss franc. But then after that is when I'll be marking, now go to other things, like now I'm looking for what are the demand, where is the supply zone. Now probably I'll come and say this is my demand zone, I mean, because I want to be long. Now I go to my lower time frame and start looking for my entry triggers. Now why should I take the trade here? Now I'll come and refine this zone, probably say this is the order block. Now I'll be looking, probably this is the liquidity that's been created, so I want it to be swept and land here, then give me confirmation. Those are the things I'll be looking for. But the essence of this video is basically explain how to come up with a market structure. And the keyword of the day is immediate market structure. Not the external thing, not the whole what swing traders or position traders are looking for. As a day trader, what is the immediate trend? And for me, my rules, I want to see 1, 2, 3 move plus momentum, but then I also have the number of candles. I want to see at least 2. You can come up with 3. And why is that important? To come up with the rules. The subjectivity makes you back test. By the way, I think people actually, people violate, don't understand the essence of the word backtesting. Fundamentally, backtesting is applying a strategy. This is actually like the definition of backtesting: applying a strategy or a predictive model. Just applying either strategy, or generally, of course, a strategy is maybe a predictive model. And let's just try this on here so that you can actually use predictive model to historical data to determine the accuracy of a strategy. Now I'll explain why I'm typing this whole thing here. If that is the definition of backtesting, let me just compress it so that you can see the whole thing here in the same place. So this is the definition of backtesting. Most of us, when we are backtesting is actually wrong because we don't have defined rules. Now, backtesting is applying a strategy or a predictive model to historical data to determine the accuracy. Now, let's assume today you wake up and you watch this video and you say, by the way you are defining swings is wrong. Do you know why I will not be shaken? The reason being, when I'm backtesting, I used the same thing in historical data, using the same rules to test over 100 trends to determine if that one can give me an edge. Will some trades fail? Yes. But now there's a catch when you don't have rules. Today you'll use 10 candles. Tomorrow you'll zoom and see, and probably another day you're going to use a line chart. Some people even will come and change to line charts here and say, I'm going to do this and mark probably these areas here, the areas that are totally visible. The problem is, yes, they are visible on line charts, but how many candles are there? What about tomorrow? What about if you see 10? What about if you see 30? What will be how will you be making decision? You need to remove the subjectivity when it comes to you defining your model. The issue, there's a word here, model. A model creates a repetitive way of doing things that can be automated. If your model cannot be automated, then there is a problem, because market analysis should be automated. In a way, you can instruct a machine to make a decision for you. And the only way the machine is making a decision for you, okay, of course, now when you talk about AI, it's a whole different thing. But let's just assume we are instructing a basic machine, a basic bot to automate your process. You can't give it instruction to decide on its own. Probably today is 30, tomorrow is 40 candlesticks, tomorrow is 20. So even without using a machine, you need to operate like a machine in the market to eliminate subjectivity. So when you are backtesting, which is applying a strategy, and a strategy has rules, you need to decide on your own. You may actually say, probably the way I'm looking at this thing is wrong. And that you may be right. The only thing you need to do is to come up with your own way and backtest using the same rule. Not one day, not 2 days, for one probably or 2 months in different market conditions. Why a long time? Because if you have you may have probably this rule, the way I'm saying, this is how I'm going to determine. If I'm backtesting it on Monday only, and probably I realized that my strategy is working 90% of the time, probably it was because the market condition on Monday favored the decision I was making. But you need to do it in different market conditions and different pairs. If you are the person who trades different pairs like me, but if you are the person who's trading one pair, you need to make those rules based on that specific pair instrument, CFD, that you are trading. You need to decide. If you are you're a person like me, for me, I tested this strategy of almost a lot of Forex pairs, probably 30, 20. The reason being, my psychology does not support me trading one instrument, because now when the market structure is shifting and I can't see something, I start making wrong decisions. It's one of the reasons why I delayed becoming a profitable trader. It's because I was thinking I could trade one pair like other people, but my psychological makeup wasn't supporting it. So for me, I decided that I'll be analyzing different charts and now applying the same rules. So we agree. Number one thing for a day trader is to make rules of your market analysis. Remember, you must have rules at every stage. Rules for market analysis, rules for market entry, rules for taking the trade, rules for exiting, rules for how you're applying your system, rules even for your own psychological behavior. Remember, lack of rules creates subjectivity that allows you to break rules without feeling bad. In fact, you failing to come up with the rules is just a way of protecting your psychological pain and lack of discipline, because after all, if you don't have rules, then if you can't break them, right? Which is already something that is dangerous in Forex and just delaying your success. So this is the thing. So I'm going to go through multiple charts, probably 5 or 6 or 7 charts, so that I can show how I'm going to apply. So, and remember, this is my higher time frame. Now immediately I've defined market structure. Now when I come to this chart, I've defined the market structure is an uptrend for me, the immediate. But the other things that I do, I'll be marking other aspects of the market structure, like this is an area, it's a major swing, this is a swing. I'll be marking these kind of things so that this is a resistance area probably. Yes, it was touched this multiple times. This is the last place we. So before I do that, even before I take the trade, now I'll go that later when I'm coming up with a full strategy on how probably to a full strategy on how to integrate both identification of market structure and entry. I'll do that so that when the market is here, I'll not be looking for longs because it's close to a resistance area. So it's not just enough to say, okay, uptrend, so I'm buying. And no, after doing that, I want to buy where I have enough breathing space before the next resistance or support. So in this case, I'll prefer buying a place like here instead of buying a place like here, because I can't buy here when you're almost. But if it breaks above this zone, then of course this becomes another area that I want to. If the price now opens and closes above this area, then I'll now want to wait for the market to come back here and look for buys now to push on the other side. But for now, my immediate market structure is uptrend, and I want to buy before we get here. I want my TP not to be here, probably be somewhere here. So I want to take the trades below here. But if the market, for example, closes again below this zone, then again my bias shifts. So rules, the most important thing, decide your rules. If they are different from mine, by the way, even if you decide to come up with totally different rules that are not even closest to mine, what is important is, are you backtesting with the same rules over time in history or in future? You can forward test by taking now trades on demo, or you can backtest by going to historical data. Now, whether you're forward testing or backtesting, are you using the same rules? Come up with the rules on how to define market structure on your higher time frame. Then on your entry time frame, again, define rules. It's so important. So enough of a rant, and I think you get the gist of what I'm actually saying. But let's just now scroll through multiple charts and I explain exactly what I mean and how I would have defined different market structure. So I'll just be clicking through different pairs, different instruments. Now let me, for example, click on silver. Okay, let's see silver. Again, I'm focusing on H4 because that is my hard time frame most of the time. Does it mean I ignore everything on any other time frame? No. Sometimes I'll want to identify key resistance on D1 sometimes, but my main time frame is H4. So, a question. If you are me based on the rules that I've explained, what is my bias? That is, what is the market structure? Because market structure defines bias. Yeah, so if you said long trade buys, you're right. Because why? My rules are simple. I want to see at least 2 candles of the same color in the same direction. See this high, this 2, this 3. Now, so my bias is uptrend. Now actually remember, I haven't said, because this thing, I haven't actually decided the trend based on this whole move. No, I'm focusing on the immediate here, close to the price. The price is here, so I'm just looking some candles back, not here. All this for me is useless. The only important thing is price is here, so I'm focusing on the immediate moves. So that's what I'm looking at. So this will be my swing, my previous swing low, this one here. Why not this one? Because it's only one red candle. But will I take a trade there? Yes, but I will not take trade there because it's a swing. I'll take there for a different reason, because this is a supply area. This is an order block. This is a H4. Now let me just explain. This is a demand area. First, I come and determine the price is in an uptrend. Now I look for key zones that I would want to take the trend. Remember, my steps are define the market structure, define the key zone second, and third, now go to lower time frame for look for entry. So I would have taken the trade here, not because it's a swing. I would have taken the trade here because after determining the market structure uptrend, so then I marked this is the supply that broke this one and broke this. Remember this part, remember this part is the one that caused this pullback. In this part were broken by this demand that emerged from this order block. So when I would have done that and marked this one as my both support, because it was stated multiple times, and demand, then I've gone to now lower time frame like H1 and M5 to wait for trades to take. Now let me just, now I will have come here when the price come here, now look for other things like fair value gap inversion, change of character. For example, let me just give you an example how I would have taken that trade. As a by the way, immediately the price swept out this place, closed above, I would have waited probably to place now a pending order somewhere here and now target this high. Of course, I didn't take the trade there, but I'm just explaining. And I haven't gone to the nitty-gritty of taking the trade there. That's just a mention. Now, that is example number one. This one, buyers, what is the market structure? Uptrend. Why? And it was H4. This is the pullback. How many candles? 3, but I need a minimum of 2. Then it was broken. So why is 1, 2, 3 move? 1, 2, 3. Why not here? Because it's only 1 candle. Why here? More than 2. Why this move? More than 2. And another rule, momentum. Momentum is here, momentum is here. Now using the same rule. Now let's go to another pair. Let's just probably click even US 30. US 30. Now of course US 30 is obviously in an uptrend. So there's nothing much to do because those are generally uptrend. No, this is the last pullback that I've seen, that is 2 color here. There's another one here. Okay, let's go to another pair. Eurocard. Let's just look at Eurocard now. Okay, Eurocard, I've already marked my analysis, but let me just remove the analysis and explain now what is my immediate trend. Now, for those who zoom and just decide this market is uptrend, for me, I don't actually. I disagree. Based on my rules, of course. Not disagree because you are wrong. I disagree because of my rules. So you need to come up with yours. So for me, I would have said, where is the last place I saw 2 candle pulling back? Here. Why those? There are 2. Then again, I saw a push that broke above. Then I saw another one that broke below. Now, this one gives me a change of character to downtrend. Why 2? Because it's this one and this one. Then it was broken with this momentum. Then again broken on downtrend, downwards by this momentum. Am I seeing momentum? Yes. Look at the same color candles with the momentum. So what is my bias? Short trade. Then what do? Now I look for what I call PEP, prime entry zones. And what are my PEPs? Order blocks, support and resistance. So I look for a place like, now I look for a place like here, which is now an order block that is also well supported by an area that was touched multiple times. So this one here, again this one here, then again this one here. So this one again, given that there's an order block there, there's area that was touched multiple times. So it's basically a supply zone that is also a resistance, which also makes me more confident to take the trade. Now I'll go to lower time frame to look for entries. For me, that is the same thing. Immediate trend on H4. Immediate, then I'll be targeting somewhere here. Now, this is not like a full strategy video. It's just basically fast identifying immediate trend on your higher time frame. Even if it's H1, do the same on H1. Even if it's D1, do the same. If it's monthly, do have rules and backtest them based on your strategy. Decide. If you say that your change of character will be here, you need to backtest the same way and now prove that you have an edge if you are using the same approach. The issue is not that we are using different view. The issue is that, are you consistent? The question you should be asking yourself every time you open the chart and take a trade, did you take similar trade yesterday? And if it's not similar, then accept that you have multiple strategies. Then say, these are two strategies. Yesterday I took a trade based on this strategy, but today is a different strategy. But unfortunately, entry strategy may differ. But when it comes to identification of market structure, I don't agree. Because identification of market structure, you need to be consistent. Entry models can be multiple because most of the time when you're taking the trade, a lot of things will be different. So, but market structure need to be consistent. Now, let me try to look at a different market structure. Let me remove this one. I've seen something. Now, I want you to ignore this part. I want you to focus on this part here. Now remember, I've stated rules for downtrend and uptrend market structure. Now, there's another thing that I want to explain why I'm saying you should have your rules. And this one I want to mark it as resistance, which it is. Now, let me use replay. Where is the replay part? To remove this part here. Good. So that you can use the replay. So assuming you come to the market and the market is behaving this way, what will be your bias on H4? And right now the third market structure that I didn't mention, which is ranging, comes in. So you also need to have rules for ranging. For me, ranging, I need 2 touches on both sides. So when I came to the market here, I would have said the market's ranging because touched here, came back here, touched here, came back here. So if I came to the market, for example, let me just even replay it further and say we come to this. Where is it? Do I even know? Okay. Assuming that I come to the market and it's there, I will not be looking for, I'll be looking for both long and short trade. Now remember, another person will just zoom in and say, the market is uptrend, or it's a downtrend. For me, no. For me, the market is ranging. So I'm looking to sell here and buy here. Immediate market structure, which are 3 types: downtrend, uptrend, ranging. Good. So for me, come up with the rules. There's nothing more important. I'm saying this multiple times. Rules. Decide how you are going to backtest. Let me exit the replay. Decide on your own. If you're okay with 3 candles, if you're okay with the whole move, do the same thing the same way multiple times. So again, what will be my bias? If you say downtrend, good, because for me, I look for immediate move. And what is the immediate move now? The market was down here, pushed up. Again, these candles here, for me, it's a sweep. Here, this part, let me just see. For me, these ones, I don't like this one because they're dodgy, so this one will be my last pullback. Why not this one? I said I don't want dodges to be the only candles there. If it's this candle plus dodge is good, but for me, this one's no, this one yes. So the close below this one was not, but an immediate close below this one makes now a change of character. So why? The market pulled back, momentum up, closed down. Now my bias is downtrend as we speak. So I look for a clear area. If there is no clear area like clear PEP, what I call prime entry point, then I ignore the chart. For example, if I can't see clear demand zone, clear support, clear resistance, then I just go to another chart. So last one probably, which pair? Just random. Okay, GBP and SAD, one of the pair that I rarely trade, but I always analyze it. So we come to H4. What is the immediate trend? If you say downtrend, good, because for me, where are the last 2 candles that are clear? Here, the dodge is here, but there's a clean candle, so it has closed below this place. Besides, you could see there's a push up, which is a push here that broke below this area, another push here, another push here. So clearly downtrend. So again, I look for clear area to look for shorts. It can be this place, which is again resistance, because why that place? Because it was touched here multiple times, multiple times, multiple times, multiple times. So my bias is downtrend, so I start now going to my strategy. What I'm explaining here is market analysis strategy. It's not a full strategy on where to get into the market. This is a strategy on how to identify the market structure. Now, it's part of the strategy, but not the whole one. Otherwise, that's all for today. And I wanted just to explain how to view market structure and backtest the right way. Please, if you want to backtest well, come up with the rules. The reason why you are come up with rules, because as we explain what backtesting is using historical data to test the accuracy of a model, but you can't do that if you are changing specs. It's just the same thing, assuming that you're playing 4K, assuming that you're boxing, and then today you are boxing 3 rounds, 3-minute rounds. Then there's another fight next week, and you're being told immediately you get to the ring, you are probably now bouncing shadow boxing, and then you're being told, by the way, this fight is 7 minutes. Then the next day you're being told another fight, you're being told, by the way, this fight is 1 minute. Genuinely, if you lost a 7-minute fight and won a 3-minute fight, then another day lost a 2.5 minutes per round fight, how will you measure the accuracy? Are you saying, will you declare yourself as a bad boxer or a good boxer because you can't? Basically, you will be confused. The reason is the goalposts are being changed. That's why even there's weight classes. You may be a good fighter at 160 pounds, but then at 165, your hands are a bit heavy, so you can't throw punches well. So then you lose. So there's a reason why parameters are set. Parameters are set to standardize results, outcomes, and opportunity. Standardization in Forex is so important. Standardize your rules. Measure your performance as a day trader. Measure your performance as a scalper. Measure your performance as a person who determines swings in this way. You can't be all over. Unfortunately, if you're over, it will take you longer like me. It has taken me long because I was all over. Today swinging, tomorrow scalping, another day trading. Today my swing is 40p, my swing is 10 candles another day. So you need, just the same way in boxing we standardize 3-minute rounds and weights. In Forex you also need to standardize your parameters of measurement. Then now train at that weight. You can't be going to a fight that you are a heavyweight and you are supposed to be probably the all over 120 kgs or probably 240 pounds, but you are training at 150 pounds. Trust me, when you go to a fight, you're not going to manage because your body cannot carry the weight. You've been training at a lighter weight, but then you are fighting at a heavier weight. You need to standardize the same way. When you are backtesting this way, backtest as if you are trading. Train a fight at the same weight you're going to fight. If it's 3-minute round, the only thing you can do is probably now fight longer so that you can have, and the only thing longer in this case is backtest more data. Not changing rules, don't change the analysis. No. Otherwise, thank you so much. Bye bye. In case of anything, there's an email in my description section. You can email, you can ask questions, you can comment. Let me know what you think and what do you think I should do next. Should I create a video on position sizing, small accounts? Should I come up with now the full strategy on how now I go to H1 and M5 to get in? Comment, let me know what you think. Thank you so much. Bye bye. All the best in your backtesting. And please backtest, create rules, define what you want, define what you're testing, be consistent and ignore the noise. All the best. Bye bye. Remember, the boy is the father to the man. Success.